Hey class, welcome to Personal Finance. Mr. Callahan here. We are going to go through chapter 18 and we're just going to do section 1 today. All right, this week I think we're just going to do section 1 and we'll get right to it. The basic question is, what do you need to know about stocks before you invest your hard-earned money? There's a lot to know. You don't just walk into it like you're rolling the dice. There are a number of key terms. Today we're going to go up to right about, I think, the large cap stock. No, I think we'll cover the penny stock as well. So these are the key terms you need to know for this week, which is pretty much this side, including the penny stock. We'll get to the bull market and everything else next week. The reason we're doing this is because we've got you in this stock market game. I want you to be able to manipulate these stocks, buy the ones that you think are attractive, buy some that are undervalued. Hopefully they'll grow in the next couple, 3 months, hopefully. And later on we're going to keep with the stock market game, but later on in the course, we're going to go back to financial literacy, savings and checking accounts, CDs and stuff like that. But right now we're going to continue with stocks. Blue chip stocks are awesome. They are considered the safest bet in the stock market. All right, they're companies like IBM and Boeing. Apple is now considered a blue chip stock. Income stocks. Income stocks have high dividends, and that's one of your key terms. So when they pay the dividend, they pay it every quarter. So the stock doesn't have to rise or fall. You're still making money on it because every quarter they're paying cash dividends. All right. The next up is growth stocks. Growth stocks are like Netflix and Facebook. People think that they're going to grow over time. They're in their infancy right now. And that's what growth stocks, that's where the word growth comes from. Next up is cyclical stocks, and it's not like seasonal stocks. Okay, cyclical stocks are good when the market's good, and they're bad when the market's bad. So they move in tandem with the market. Penny stocks, they're questionable. They are anything under $5. All right, so that's the only thing. I think that's in my book. Your textbook actually says $10 a share. All right, so there are some stocks out there from famous companies that are under $10 a share. Large and small cap stocks. That means cap is talking about capitalization, how much a company is worth. So a large cap stock is a stock with a large, the company has a large value, usually in the billions of dollars, whereas small cap stocks are companies that are only worth a few million, under 100 million. Defensive stocks is a stock that remains stable during declines in the economy. All right, so companies that issue such stocks have steady earnings and can continue dividend payments even in periods of economic decline. Many blue chip stocks and income stocks like Procter & Gamble and Johnson & Johnson are defensive stocks. All right, I hope I have mentioned some stocks that you have in your portfolios as I do these presentations. So let's move on. These are the objectives of just this section 1. Explain why companies offer common and preferred stock. Discuss the reasons for investing in common stock and discuss the reasons for investing in preferred stock. First key term, I think, is private corporation, and that's a business or company owned either by non-governmental organizations or by a relatively small number of shareholders. It's usually a family-owned business, private corporation. It does not offer or trade its company stock to the general public on the stock market. So private corporations will have stock, but they won't sell it on the public stock markets. Okay? A public corporation is simply a company whose shares are traded freely on the stock exchange. And public companies are the ones that we're trading on howthemarketworks.com. You don't trade any private companies, in a simulation or for real. So every company that we're buying and selling in our game is a public corporation. So why do investors purchase common stock? That's the first question. We can get income from dividends. I told you that's a key term. Look it up. The dividends are key to a lot of investment. Hopefully your stock appreciates, which means not only do you collect these sweet dividends, but then your stock price goes up as well. So the value of your stock goes up. You can get increased value from stock splits. We'll talk about that in a few seconds. And you get voting rights. All right, so you're allowed to vote as to who's going to be the chairman of the board, what companies are going to do the accounting for the company, and things of that nature. So you have some say in the company when you purchase common stock. So the other stock is preferred stock. All right, it's a little more expensive. Most preferred stock is more expensive than common stock, but it's considered a safer investment than common stock because the preferred stock holders get paid their dividends before the common stockholders get theirs. All right, so there is a pecking order. The preferred stock gets paid first, and it is a predictable source of income. Like I said, we invest in stocks to get appreciation, but we also invest to get income, such as in the form of dividends. So corporations may offer this preferred stock, and why is it more attractive? Because cumulative preferred stock, that stock, that their unpaid dividends build up and must be paid before any cash dividend is paid to the common shareholders. So you can accumulate a lot more cash with these cumulative preferred shares. Then there are convertible preferred shares or convertible preferred stock. That means that you can buy this preferred stock that can be converted at a later date into common stock, and you can get more gains from common stock as that grows as well. This participation feature is really not used a whole lot. I'll tell you what it is. Some corporations offer a participation feature, which allows preferred stockholders to share in the corporate earnings with common stockholders. So after a required dividend is paid to preferred stockholders and the stated dividend is paid to the common stockholders, the remainder of the earnings then is shared by the preferred and common stockholders. Like I said, this is very, very rare. Okay. What is a stock split? A stock split is pretty easy to understand, okay? It's a corporate action in which the company divides its existing shares into multiple shares to boost the liquidity of the shares. And I'll explain this. Although the number of shares outstanding increases by a specific multiple, like 2 to 1 or 3 to 1, the total dollar value of the shares remains the same compared to the pre-split amounts, because the split does not add any real value. There's a place for it in the market. It's to make your stock more attractive. As you can see up here, it might be hard to see, but right up the top, the most common split ratios are 2 for 1 or 3 for 1. And that means the stockholder will have 2 or 3 shares respectively for every share that they held before the split. But it really doesn't do anything. Take a look at the market cap here. It does not change from 100 million. In this example, this is a 2 for 1 split. See this up here. The number of shares outstanding is 10 million. What they simply do is double it, so it's 20 million, and then they cut the share price in half. All right, so it's 10 million for $10 pre-split, 20 million for $5 post-split. It does nothing to the market cap. What it does is it makes the price of the stock more attractive. All right. Maybe if you're, if you're a rich guy, you can afford $10 a share. But if you're a blue collar person, you can't afford that $10 a share. If they do a split, it looks more attractive to you. This is simply the 3 for 1. 10 million shares outstanding, $10 a share, 100 million in market cap. If we do a 3 for 1 split, now there's more shares out there, 30 million outstanding shares, but the price has come down by 1/3, which leaves the market cap unchanged. All right, so we asked you before, what do you need to know about stocks before you invest your hard-earned money? And you can make what you need to know is you can make the best investments for your financial situation when you understand the stock market and learn how to evaluate, buy, and sell stocks. Some people say just buy it and hold it, okay? That used to work maybe back in the 50s and 60s, 70s and 80s, and even into the 90s. But after a couple of market hiccups, a lot of people have been, kind of weary of that buy and hold thing. If you need dividends or income, you want dividend stocks. And don't forget, if you buy a stock, you're not married to it. And if you make a mistake, it's not a life sentence. So the Chapter 18.1, go back to Schoology, and the discussion question worth 20 points is defend a corporation's decision to split its stock when the stock price has risen significantly. All right, so I will leave that up to you. Thanks so much. This is Chapter 18, Section 1. We'll get into Chapter 18, Section 2, probably next week, so keep an eye out for it. Thanks so much and have a great week. Oh, enjoy the snow. Thanks. Bye.